Hello, it's Christoff Oosthuysen here. I would like to quickly introduce you to an easy way of understanding your financial accounts as a way of measuring your business success. Now, it is indeed so that a lot of entrepreneurs, especially those in the creative industries or those that are driven to create some innovative ideas, may not want to focus naturally so on the financial side. But as money is the lifeblood of business, it is extremely important for our success as entrepreneurs and business owners to keep tabs on the financial aspect of our business. In fact, if we understand that the numbers, the accounts, are merely a reflection of what is happening in the business, it becomes much easier for us to see the usefulness of understanding those numbers as a guide or as a measure of how we are progressing with our plans. So, without any further ado, let's jump into this. The easy way of understanding it is that there is a line, and the horizontal line provides us a guide for positives or pluses that is in the positive, so to speak, when we speak about money, and the negatives, the inflows and outflows, one could say. So above the line, we put the positives, and below the line, we put the negatives or the minuses. And that is as easy as that to understand accounts, is that's the difference. However, there's also a vertical line that separates our performance from our value. And I think that's a very important distinction that we sometimes miss if we are not accountants or bookkeepers that are working with financial reports and the systems that are underlying the financial reporting, where value of a specifically more sophisticated businesses becomes quite important. But for us as owner managers or as entrepreneurs, it is most important to make this distinction too. So on the left, we can talk about our performance, and on the right, about our value. And by the way, this is not my creation. This is my friend Precious Mvulane's creation. She is, by the way, a chartered accountant, but she works with entrepreneurs a lot. And I found this a very useful way of explaining how accounts fit together. So I'm really kind of relying on her insights, and I refined some of the things that she's taught me in explaining this to entrepreneurs. So at the top, positive; at the bottom, negative, in terms of the horizontal line. And in terms of the vertical line, we put our value, our business value, on the right, and our business performance on the left. Okay, that's the framework that we use. And then we've got 4 quadrants to work in. So all our income, the sales that we make, the interest that we earn if we have a bank account, the fees that we charge, all of that we put in the left top. And below that, we put the costs. And of course, the things that we owned by us, on the top right, because it's a positive, it's an asset, it's a value that we have, and what we owe to financiers or to our suppliers, whatever, we put at the right bottom. So you can see there that we've got the performance on the left and the business value on the right, and the positive contributors at the top, and that we need to deduct at the bottom. And that gives us the 4 quadrants to work in. So this is accounting. It's as simple as this: 4 quadrants to work in, and we can explain all the movement of money through understanding our business finances in this way. It's quite easy, in fact, if we see it in this way. So, sales, fees, interests sitting there at the top, and then all the direct costs, the overheads, and the once-off costs. It's important for us to make this distinction between the direct costs, those costs that are associated to a sale, and the overheads, those ongoing expenses that we will have regardless of making any sales, and then the capital investment that we need to make, the once-off costs that we need to account for too. So we'll come to this thing about overheads and direct costs just now when we speak about break-even, which may be a term that you've used or heard of before. And then in terms of the right, of course, our bank accounts, the money that we have, all the assets that we have at the top, and then what we owe others, the debt, what is due to others below that. And that gives us then the ability to say, in this framework, that in terms of our performance, we can see to what degree we are profitable. What profit have we made is the measure of performance. And it's a measure over a specific time. So it could be the profit that we made over a month. It could be the profit that we made over a year, or a loss if it didn't go so well. But basically there we've got the performance measured in terms of the profit that's calculated income minus costs. That's quite straightforward. It's so logical, and perhaps it's something that we all know because we see how that affects our business and what is left in the bank. But what's left in the bank is on the right. Okay, so it's a specific period on the left, the performance. On the right, it is our value as it is now. It's more like a picture or a snapshot of what the value of the business is at this point in time or specific point in time in the future that we project. So value equals to what is owned by us minus what is owed to others. And that gives us what's sometimes called the net worth, the value of our business. So you can see that the health of our business is indicated by this state that we're in. And if the things that are owned by us are more than the things that is owed to others, then our net value or net worth will be higher. Okay, so that's the basics of it. Income minus costs gives you the profit, and what is owned by us minus what is owed to others gives the value of the business. And this is the whole accounting system. What a chartered accountant or bookkeeper or anyone will explain to you, the reports that I'll give to you are all reflected in this 4-quadrant system that we can use to demystify what sometimes feels very intimidating. And that's the first point of value that I would like to offer you here today in terms of how to understand the accounting and bookkeeping of your business. But we can go a bit further to say we can easily understand that there's a relationship between these elements. So the more profit we make, the value of our business will increase. So if you don't do anything else with the profit but keep it in the bank, then those things that are owned by the business will increase. The bank balance will increase, and therefore the value will increase. The opposite is of course true too. If you start making losses, it will deplete the value that you have. So the way to create a valuable business and to increase the value of your business is definitely to be making profit. So how can we do that? We can attend to the things above the line, which we want to maximize because they're positive, and we can attend to things below the line, that is the horizontal line, and minimize those so that we can also maximize the profit and eventually the value of the business. So in our business, in the activities that we plan, we will see this reflected in our accounts. If we are able to increase the value of the business, we will be able to see the measures that comes in the financial report that we receive. Okay, so increase the price, increase the quantity of the products that you sell, change the product range, add to the product range, are all kind of strategies that you can employ to increase your income. So if you look at your financial reports and you see we are battling to be profitable, how can we increase our income? And here are some strategies, sort of make some price changes because your business model requires such. Increase the quantity. How can you increase the quantity? What are the strategies that you need to employ to increase the quantity of the sales, or change in the product range so that you can actually increase the sales? And of course also you can look at how you can reduce the costs to become more profitable. So are you working efficiently? Is there inefficiencies in the way that you organize your team, or if you're in the production of something in the production line, or are there costs ascribed to the business that is in fact not business costs? So the cost efficiency is an important element there. You can maybe change your suppliers, and in that way you can increase your profit too. On the right hand side, it's about the assets, about the value of the business. You want to own assets that are creating income. So what happens in many situations is that businesses over time accrue assets, specifically equipment that is sitting there not adding value in terms of sales. So are these assets that are in your business contributing towards the income is a question to ask, and if not, then some changes may be needed. And then of course you don't want to owe too much money to the banks that are charging a big interest and so on. Perhaps shareholders are a more suitable way of financing the business, but the combination of those you want to minimize so that your value of the business is optimized. Okay, so we can see there's a relationship between these two. I'm quickly going to run through that. It's not too complicated, but just to give you a sense of how the flow of funds actually bring these four elements on the four quadrants together. So when we, the things that we own, the equipment that we need to produce or to sell products or services, often comes as financed from financial institutions, but also from shareholders, or sometimes even your suppliers may be patient in waiting for you to pay them. So in that way, you can finance what you need, the assets that you need to create the income. So those assets allow you to create the income. And if you've created the income, you can match that income with the expenditure. Sort of what do you need to pay to make sure that you can deliver on those sales. And then that, of course, if it gives you a positive cash flow at the end of that, it contributes towards you reducing what you owe to other people. So decrease debt. And in that way, you've got the cycle completed, and see how the one influences the other. So definitely on the left, in terms of your performance, the better your performance, the more you're going to create value on the right, the value of your business. And that's the simple way, the easy way of understanding it. Four quadrants, sort of positive at the top of the horizontal line, negative at the bottom, and then the vertical line, you talk about your business performance, how are you doing, your costs and your income on the left, and then on the right, your business value, what you owe others and what is owned by the business. So that is really straightforward. Your good performance on the left will increase your value on the right. And, guess what? In the bookkeeping systems, the reports that we get to show us how these things are performing, how we are doing, or where we're at in terms of the value, are called certain things that we might have heard of. So your performance is measured by your income statement, or is shown on your income statement, which is for a specific period, perhaps for the past month or for the past year. It's also sometimes called the profit and loss statement. So if your accountant asks you, do you want to see your profit and loss statement? It is about your performance over a specific period of time in terms of the profit that you were able to make. And then, of course, on the right, we've got what is called the balance sheet. And that is a report that shows you how much you owe other people at the bottom and what the value of your assets are, and everything you own are on the top. So that's performance on the left and value on the right. So that's the system that I learned from Precious, and that I explain to a lot of entrepreneurs and business owners in making sure that we understand our accounts better, and how measuring certain things like profit and value can help guide us in the practical decisions we need to make in growing our businesses. So part of the challenge sometimes is to find an appropriate accounting process. Now, what is this accounting process? And we can quickly run through that. It starts off by us saying there's a transaction. We sell something, we buy something, we agree to exchange some value with someone. And then we've got a source document, something that is proof of that transaction. So in a lot of instances, it's invoices. It may be kind of a service level agreement or some original document that we can show what that transaction is about and what the value of the transaction is. So it can be then captured or recorded in our bookkeeping. That's sometimes done automatically if it's linked to a bank account, for instance. Sort of other times bookkeepers actually have to capture that as transactions in our accounts, our books. And then you may have heard your accountant say we need to reconcile our books with the bank statements and with the client statements to make sure that all the transactions are recorded correctly, so that then we can produce our management accounts. And there's the profit and loss statement that we heard of before, as well as the balance sheet, but most importantly also a cash flow report, which shows to what degree we've been able to manage our cash and stay cash flow positive. And for many small businesses, that's quite an important element of making sure they stay sustainable. So how the cash flows through the business and the availability of that cash is often a key element in making sure that small businesses are successful. Okay, so there's also then another kind of report which is called the cash flow report. Maybe for us the cash flow forecast is an important one, and looking at how the cash has flowed in the past will help us in understanding to project in the future, so that we never sit without the money to pay our bills, to pay our staff, to pay ourselves. Okay, so when it comes to performance, there are ratios in the accounting profession that are often used to indicate whether a business is a going concern, or how healthy the business is, what the profit level of the business is, and so on. We don't have to go into too much depth about those. You will find your own ratios and targets to set sales targets, for instance, an important one. But to understand definitely what this thing called break-even that I referred to earlier is important. So what is the break-even point? You basically use this as a calculation to determine how many items you need to sell to cover your expenditure and direct costs. So you also remember I referred earlier to the importance to distinguish between the ongoing expenditure that you'll have, whether you make a sale or not, and the direct costs, which are related to the sale that you're making. So it's the cost to actually being able to sell. So if you are in retail, it would be what you pay for your stock, or if you're in production, it would be what you pay for your materials and on your production side of things for that specific item, adding the value to that specific item that you're selling. Okay, so that is before starting a profit. So if you sell more than the break-even point, it means you're making a profit. If you sell less than the break-even point, it means that you make a loss. So that's quite an important metric to have, especially if you start off, to know what your target is, just to be surviving, just to be breaking even. You can do this in different ways, so there's, for instance, you can calculate it in monetary value, like rands, or in units, how many units, but it gives you a target of how many units or what sales level you need to be on to make sure that you are not losing money. Okay, so that's very briefly, a break-even is one of the measures, but in that process, the accounting process, you may find that there are ways for you to improve it. So what changes could you make in that accounting process to make it more efficient, so that you can get the numbers that you need maybe at the end of the month, or sometimes even the end of the week, to know that your sales is on target, to know that your costs are in check, to know that you're profitable, and then that's the performance side of things, of course, and then to also know that you're adding value to your business. So you can ask yourself, what can you refine in your bookkeeping and accounting process? So if you look at the steps that you take, find something that's useful for yourself, a process that's useful for yourself, that allows you to keep the books as they should have been done, and to then be able to identify metrics for you so that you can keep improving your business. And that's basically